Welcome everybody back to another episode of the Traders Induction program here on my YouTube channel. Today we're going to be diving into some of the basic risk management terminologies and principles that we can implement within our trading to ensure sustainability and longevity in this game. So first up, the definition of risk management is the process of identifying, assessing and prioritizing risks to minimize their impact. Now, I really like the way that this was worded, so I'm going to dissect it a little bit and go through each of the different components. And the first being identify. So firstly, we want to identify the potential risks when analyzing and executing within the financial markets. You know, some questions that we can ask ourselves are, is there any upcoming news announcements that we need to be aware of so that we're not blindly going into some high risk news in the next 30 minutes as we're executing a position on a currency pair that is impacted by these announcements. Something else to address is the volatility of the asset. So for example, trading an FX major such as the euro dollar, it's not as volatile of an asset as opposed to something like an altcoin within the cryptocurrency market. There's different levels of volatility that can affect the position and the overall risk of that position should anything happen. Now, next up we have assess. So we need to assess what the risks are, and we can consult with our trade plan to see what is it that we should be doing and whether or not we're acting in alignment based on our plan. So what are the risks? You know, are we executing in some high volatility environments with upcoming news announcements? Is there some technical factors that are contributing and negatively confluencing the position that maybe increases the risk and and lowers the probability of the trade playing out? So in these situations, it's important that we do then refer back to our trade plan, because ultimately that's going to be our Bible and our cornerstone that allows us to consult in the moment and get that real-time response of, is this something that I should be doing or is this not something that I should be doing relative to the risk management parameters that have been outlined in the plan. Moving on, we have prioritization. So we want to prioritize the risks as well. So given that we are trading the financial markets, there's no way to completely mitigate all of the risks and trade in a completely risk-free environment. There's always the potential for slippage or accounts or being blown or money being lost because of any number of different factors that can contribute to the whole overall risk of the position. Just because the money sat in the account doesn't mean that the broker can't go bust and the pot's gone. Or if you're in an execution and maybe there's some funny business with the brokers going on that can cause a position's spreads to become wide and you get tagged out maybe with some extra slippage, so there's some more financial risk on that sense. But touching on the prioritization of the risks, this one is a bit more of a technical side. We want to be filtering our watch lists and we want to be filtering down the positions that we're looking at so that we're taking positions that are ones that we want to take and ones that we believe are higher probability but also have the lowest risk of something going wrong. So for example, if you're looking at taking a position on the US dollar, you can go and look through the other US dollar pairs that may be shaping up and seeing, is that same setup present, but also if so, are there any less negative confluence factors or more positive confluence factors to taking one asset and one cross over the other? Now, one of the primary quotes that I like to live by when it comes to the trading in the markets, it is that we are risk managers first and traders second. Capital preservation is key, survival is first, and then we can look to make the profits after we are able to sustain ourselves in the markets and not run into ruin. Now, a couple of different risk management concepts that we can go over quickly. First up, volatility. So market volatility refers to a few different factors that can be externally influencing the price action of an asset. However, in a general nutshell, the volatility of an asset basically refers to how erratic the price moves. Is it all wicky all over the place? Is it moving and not adhering to any different levels of structure and support and resistance? Is it a very temperamental asset? On the flip side as well, with regards to volatility, you know, our market's in a state of uncertainty where things are whipsawing backwards and forwards, and we got 100 pips here, 100 pips there, spreads are through the roof. You know, the volatility increases the risk across the different assets. Another thing that can definitely impact the volatility and the increasing the risk on the assets that we're trading is market fundamentals and the geopolitical environment. For example, when Trump was in the administration and he would tweet, the markets would go again whipsawing all over the place at a moment's notice based on anything that he was tweeting about and speaking about on live TV or on the platforms. We've got major news announcements coming out. Are these going to be affecting the price action in the markets? Again, the highest spreads, the erratic movements, the geopolitical environment, for example, is there wars going on? And at the moment there is, so things are very uncertain, things are very unstable, especially with regards to the equities and commodities markets, where different players in the world that kind of control and represent different sectors of the marketplace are all going through their own turmoil and their own struggles, which will impact and affect the volatility and of course the price movements within the markets. Now, another one is the updraw and the drawdown. So this one is purely focused on the performance of the individual trader, and what this refers to is the equity in which the account that you're trading, or the performance of your previous trading history, is relative to the baseline of the account. So this is very common when it comes to the funded accounts. You get given an account at say $100,000. The updraw is how much you're in profit, and the drawdown is how much you're in a negative equity. So when we're talking about the updraw, the emotions of elation and greed and all of those positive feelings can be amplified because we feel like we've cracked the code, we're doing really well, you know, we're in a position of updraw, we've got maybe a winning streak under our belt, so we're feeling good, and we're being a lot more blinded to the potential risks and the potential downside because we're above that break even, we're doing well, so there's nothing to fear. Now, inversely, with the drawdown, this is where things can get a little bit hairy, because it can be a very slippery slope very easily. When we're taking a loss after loss after loss, suddenly we're 3-4% down, especially with the funded accounts halfway to a drawdown limit, and we now have to feel like we're crawling our way back up to break even. You know, things are going against us, we're not feeling too good, maybe we're forcing positions that aren't there, we're jumping into the lower quality impulsively because we feel like the market owes us this money back, we're better traders than what our accounts are saying. So the updraw and the drawdown can really play on the human emotions and the psyche, and it's important to manage these emotions and not let them impact our future trading. Another huge one is the mental and the emotional state. Now, our mental state on a daily basis, as well as our emotional states, people are going up, they're going down, they're being happy, they're being sad, and especially with the polarity of the social media and the news networks, we're being swayed to one side, swayed to the next, and it's just a battle of our emotions left and right all day, every day, especially in the geopolitical turmoil that we're in on a global scale at the moment. All of these different things affect us on a day-to-day that we then project into the market and bring in our own emotional and mental state projected onto the market as if we know what needs to happen, we know what's going to happen, or we expect that the market does this because this is how I'm feeling. On the other hand, with regards to the mental and emotional state, maybe you're feeling sad, maybe something externally has happened, you've had a fight with your girlfriend, and you're not feeling too good, you're a bit down in the dumps, fuck you market, why are you taking my money? Or, I see this, please make it work, I'm feeling down, like, bless me and give me the money. The market doesn't owe you shit, so you can't be coming in projecting all of this into the markets. You need to be executing and analyzing the markets in a balanced and neutral mind state, from a mental perspective and an emotional perspective that doesn't cloud our judgments, you know, especially going back to the drawdown and the updraw. If we're on a losing streak, for example, and we're feeling, you know, a bit deflated about the position that we're in the markets at the moment, you know, we're projecting that into the markets, and we're maybe perceiving it in a way that is very in a scarce mentality, like it's loss everywhere, it's all doom and gloom. So a balanced mental and emotional state is very important when it comes to analyzing and executing in the markets, so that we're doing so in a calm, collected, peaceful, and balanced manner. Now, some strategies that one can implement to ensure that we are making sure that we're acting in alignment to our risk management procedures and policies. Just to preface quickly, we will be going over this in a bit more depth in the future videos. But for now, just a nice little overview of the risk management. These are some of the strategies we can implement. So first up, we have the using of the appropriate position sizing. So what this means is if you've got £1,000 in account, you don't want to be throwing £500 on the line on each individual trades, because 2 trades, that's a loss, your account's busted. So generally a good rule of thumb is to sticking to 1%, 2% max on each and every single position that you execute in the markets, so that we're able to limit that downside potential, because we're only putting in a little bit and a little bit. For example, with 1% of the account risk on a $100,000 account, you're risking $1,000 on a position to maybe make a 2-to-1. To make a $2,000 position, you're risking $1,000 a position. It's about those small incremental wins and those little hits, so that when you do have these losing streaks and these losing periods, you're not risking 10% and you're down 60% of your account after a six losing streak. So we need to be very on the ball with regards to our risk management and our position sizing especially. So this goes back to the position sizing calculators that I did speak about in the previous videos, where you can download Stinu or go onto my FX book, make sure that we're putting in a small risk amount of maybe 1 to 2% of the account, and then trading accordingly to that. Another big problem that can come into play, especially again when in drawdown, is we're down 2%, so maybe we'll up our risk so it's quicker to get back to break even, and that's very detrimental, because like I said, if you're down 2%, you suddenly up your risk to 2%, you could be down 4, 6, 8% just like that. It can be a very slippery slope. So appropriate position size management, 1%, 2% tops, and that's it. Ensuring a positive risk to reward ratio. Now, again, we've touched on this in the past couple of videos, where we want to make sure that we're not risking more than we're affording to win. So anything less than a 1-to-1, risking 1,000 to make 1,000, anything less than that, you have to have an incredibly high strike rate to ensure profitability in the markets, which is not very sustainable. It's not something that we can really measure ourselves and control against. So for example, up in the top right hand corner, we have the graph here with the 1-to-1 risk to reward ratios on trades. You need to have at least a 51% strike rate just to ensure profitability back towards break even. A risk to reward ratio of 2-to-1, you need a 34% win rate to remain profitable towards break even. And then 3-to-1 risk to reward ratios on position, you only need to be right 26% of the time in order to be trading at break even or in a slight profit. So the higher the risk to reward ratio that we can project and be positioning ourselves accordingly to, the less times that we actually have to be correct on the bias of the position. So there's a balance to that as well. We don't want to be just taking 7, 8, 9, 10 risk to reward ratios, because then you bring in the whole idea of, well, are we putting our stops too short and we're forcing the markets, or are we looking for things and trying to run trades that aren't really meant to be run to that extent? So keep it within balance. I like that 2-to-1, 3-to-1, sometimes a 4-to-1 risk to reward ratio. That's the kind of sweet spot that I like to trade within. But the 1-to-1s, I really have to see a lot of conviction and an edge present in the market to justify the entry. Now, moving on is avoiding unsober mindsets and a distracted execution. Now, I myself personally have executed plenty of positions whilst under the influence of various substances, and it can be very detrimental, because we are not executing in a clean mindset. We're not thinking properly. We're not interpreting all of the data that is presented to us at that moment in time. So our judgment is clouded, our vision is impaired, we are not seeing all of the information, and we're not thinking straight. So this can very quickly lead to looking at things that aren't actually there. Maybe we've fat fingered the execution on the broker. We've done something wrong, and it can very quickly go south when we're not in a clear, sober mindset. As well as distracted executions. If there's someone having an argument downstairs and you're trying to execute, this isn't the right kind of environment that you want to be executing in, because your mind's half out here and your mind's half here. So you're not really with it, you're not really present, and you're not really giving all of your mental energy towards exactly what you need to be giving it to, which is the task on hand of analyzing and executing in the markets in an efficient and safe manner. Now, Another one is planning the trade and trading the plan. Very, very, very simple but very powerful concept when it comes to execution in the markets. We want to be analyzing the markets and making a plan prior to the moment occurs, the moment of execution occurs, because in that very moment, once the position has shaped up, if we've not made a plan on what we're going to do, we're only acting on emotions. And this is not the type of trading that we want to be succumbing to. We want to be analyzing in advance in a calm and collected and neutral standpoint where we're not attached and we don't have a bias and we're not projecting our emotions into the markets. We are planning the trade in a balanced and neutral mind state so that when the position does shape up, we're executing according to something that we planned out prior to it shaping up. And now we just have to follow the plan. We trade the plan. We follow the rules. We do the checklists. We do the routines and the processes surrounding the execution, management, and closure of a position so that we're doing it according to the trade plan, which is tested and verified against the statistics and our data collection methods. Another one is recording and reviewing our trading data. It scares me how many people don't actually record any of their positions. They don't have a trade journal. They don't review all of their previous positions. They just look at the equity or the balance on their brokerage account and look at that as a measure of profitability. And let me tell you, there's no sustainability and there's no longevity with that behavior. There's also no professional nature to it. You know, if you're an estate agent and you're making sales and you're not tracking the sales that you're making, how can you tell yourself that you're a good sales agent if you've got no data to back it? It's a very sensitive game in the market, so if you're not attuned to all of the slight deviations that you make within your trade plan and your execution on a day-by-day basis, these things can really creep up and snowball and affect you and really solidify bad habits. And you don't even know that you're making them because you're not reviewing the data or even logging the data for that matter. So keeping a trade journal that you not only fill out on a routine basis with all of the live executions that you make, but also making sure that you are then going back over that data so that you can pick apart all of the different positions, what worked, what didn't work, am I making mistakes in the executions, so that you can keep yourself on the straight and narrow. Now, in summary, that was the risk management section of this module. We went over the definition of risk management, so you now know what it is and what to be looking out for. It's a huge aspect with regards to trading and investing. And again, we are risk managers first and traders second. Next up, we have a few of the different concepts, so risk to reward and market volatility and things of that nature that one needs to know what they're looking for in the markets in terms of risk management and mitigating those risks. Then we have a couple of strategies. Now, these aren't all of them. There's definitely plenty more that we could have spoken about with regards to how you can implement these actual actionable steps and practical methods of risk management and procedures that we can follow through in the live markets to make sure that we are adhering to our rules and are adhering to the safety mechanisms that we do put in place for ourselves. But as a nice general overview, we just want to keep it clean. We don't want to be acting on emotions. We don't want to be risking too much. We want to be documenting and recording everything so that we know what we're doing and things of that nature. So with that being said, that was the risk management section wrapped up. Tomorrow we're going to be chatting about the development of a trade plan, which I'd like to believe will bring full circle of everything that we've discussed in this first week and honing in all of that knowledge and putting it into a plan that then we can refer back to and really lean on as a strong foundation of what good trading looks like in the market. So with that being said, thank you very much for your time, and I'll see you in the next one.